Hello everybody and welcome to the Cyclical Investors Club YouTube channel. Today we're going to be expanding a little bit from the single stock coverage that I normally do, and we're going to take a look and sift through 10 auto manufacturing stocks since they're likely in the beginning phases or middle phases of a down cycle. I thought it would be interesting to take a look at some of them, share which ones I'm not interested in, which ones I am interested in, if the price is right, and then kind of where they stand in relation to those prices. So I'm actually going to be sifting through 10 of the auto manufacturers today. And this will just be how I view them for my specific strategies, kind of some of the things that I use to kind of sift out the ones that I think are just harder to figure out, harder to judge whether they'll recover and produce good returns, or harder to figure out when to buy them. So with that said, as always, this isn't individual investing advice. This is just how I analyze stocks. You can get a 25% off to Fast Graphs, which is what I'm going to be using here in this video for most of these. I have a link down in the description for that if you're interested. And then I also have links to my Patreon and the full Cyclical Investors Club service over on Seeking Alpha. You'll see that I actively track the ones that I'm most interested in my spreadsheet over on the Cyclical Investors Club, so we're always kind of watching that. And I've added a few recently now that this down cycle is kind of getting a little bit more interesting. It's getting started. So let's just get into it. Let's start with Volkswagen. This is the, I don't know if it's the Frankfurt exchange maybe. I know it's the German exchange, but I forget which one. But anyway, this is going to be in euros. The US ADR just didn't have as much data going back, so this was a little bit better. So, but that's not necessarily what's important here. What's important for me is, generally speaking, if we just go back to 2007, right, before the financial crisis, and you look at the returns since then of VW, they're basically the same as inflation, right? And if you just kind of randomly picked a spot here in the middle, the returns are pretty similar. That one's actually a little worse. Now, occasionally it has had these spikes upwards here, but I don't really know that those are predictable. So, and then we had I think this was the kind of Dieselgate or whatever when they were fudging data on their emissions, but which is what this spike down was. So that was kind of a one-time thing. But you can definitely see that they're economically sensitive. Earnings fell 80% during the Great Recession. But the stock price and we see that adjusted earnings are pretty strong right now. I haven't looked at the basic earnings yet. See if that makes a difference. A little choppier, but earnings have been good because they've been able to charge people a lot of money for cars. But I think the beginning, we're seeing earnings have peaked. They're starting to come down. This is definitely the beginning of a down cycle. The market's already anticipated this well in advance. The other thing with Volkswagen, this goes for Porsche too. I almost bought Porsche in 2020. I decided not to. It had a big spike up and now it's fallen all the way back down. And then they have a relationship with Volkswagen that's really kind of a corporate relationship that's pretty complicated. You have like the Porsche family, and then Porsche owns shares in Volkswagen. Volkswagen owns shares in Porsche, and then there's different classes of shares. And when I started getting into it with Porsche, which started to look interesting price-wise, that's just not the type of kind of corporate complication that I want. I want things much simpler than that. It just makes it too easy to manipulate things, to hide potential issues when things are super complicated like that. And you can understand how mechanically it works without really understanding what the implications of those complications are. So I'm the type of person where if I really don't know it, I just avoid it. There's many other auto manufacturers. And the thing with auto manufacturers is they follow similar patterns. I mean, they're going to have similar down cycles unless it's a company specific thing like this Volkswagen thing was. So my philosophy is if the stock prices are falling similarly, you want to buy the best ones during the down cycle rather than the other ones, because the potential rewards can be similar, but the risks are different. So you take the lower risk for the similar reward. Now there is a small exception to that, I think with Ford maybe, which we can get but we can make adjustments for it, and we'll get into that in a second. First, I want to cover the ones that I don't really track. So Volkswagen's one, I explained why. Stellantis is another. So these guys I think are like Chrysler, Jeep. They have a lot of different brands, but we can see much harder downturn back in 2009. Okay, earnings were deeply negative. So a deep cyclical. We're starting this down cycle here, and it's already pretty steep. And the thing is, like, analysts are expecting $4 a share, but it's entirely reasonable to think it will be half that. Maybe not this year, but by next year. These guys, they just charge a lot of money they really gouged people during the pandemic, in the recovery afterwards. The stimulus money was out. Interest rates were low for a couple years before the Fed started raising. So people had a ton of money and a ton of borrowing power. And we had a limited number of vehicles that were being manufactured, and they took full advantage of that, which is their business. That's sort of their job, at least. I don't know about the short term. Definitely the short term benefits were there. I don't know if that's going to work out to be a long term benefit, because you have a lot of people that borrowed money for vehicles that they really couldn't afford at low rates, or essentially, but these prices are not going to be maintained. So if you go to these car dealers now, their lots are full of these vehicles. Before there was a limited number. Prices have been very slow to come down on new vehicles. And so this inventory sitting, I think with all these auto manufacturers, they're hoping interest rates get lowered. That will hopefully bail them out a little bit, because they haven't been producing enough cars really the past couple years. And so they've just been charging more for them, which again, you can't blame them from like a business point of view. And it's hard to know whether we'll go back to this period before the pandemic when there was a good supply of cars. You could buy them at reasonable prices and at pretty low interest rates too. That might have been a Goldilocks period for consumers. But the point is, if things deteriorate and people's credit starts getting hit more, and there's any kind of slowdown in the economy, which is actually starting to happen right now, these guys could get like really creamed. So I would not. I think these expectations of earnings the next couple of years are totally ridiculous by analysts. I usually don't try to predict too much, but my estimate would be they're down under $3, under $3 a share in the next year or two. So, so for Stellantis, let's get rid of. Don't need dividends. Maybe there we go. I just want to look at the stock price because it gets a little distorted when you add in the earnings or whatever. So this is a cyclical business. I like to look at these drawdowns and see what the actual price drawdowns were. That's a 90% drawdown during the Great Recession, leading into the heart of the pandemic. Remember, this actually peaked in early 2018 with a lot of other industrials and cyclicals that I warned people about, down 75%. So these are huge drawdowns. And if you ask me, the bubble that we just had in auto prices, basically, it's bigger than at least the 2018 one for sure. And it's only down 50%. So this could, I would say base case, it falls another 50% for the stock price. And then if we have a recession, like a real recession, it could go 85, 90% off its high again. So, and then if you look at this recovery period, I usually like to go 5 years. Now, that's if you picked the very bottom. If let's just say you did good and you bought it like $5 a share. If you go ahead 5 years, that was in November 2008. That's pretty close to the bottom. If we go to 2013, which is 5 years, we'll go 11, 20, that's 2014. We'll go like 11, there we go. That's like 5 years. So no return. So this is one of the other problems is I can't really count on a recovery with this particular cyclical in a timely manner. Now, eventually they did recover, right? If you're willing to hold for like however many years, 2008 to 20. If you held for 10 years, you could have got a 18% CAGR. But it takes a lot of patience, and you never really know if it's easy to lose confidence when things take forever to recover. So I like to see quicker recoveries. So this is an avoid for me. One, now if it was down 90% and everything else was doing great, then maybe. But it doesn't quite. I think there's better options. And it's definitely too expensive right now. I think it'll fall another 50% if I had to guess. GM, so here's the thing with GM. I don't buy stocks unless I have a recession to gauge, not cyclical stocks, unless I have a recession to gauge how well they can survive and come out of them. And GM did not survive. So the last recession, so that kind of just immediately marks them off my list as too hard, because I don't have a way to gauge to say, okay, what is the market likely to do with this stock? What are their earnings likely to do? So I'm not saying that during the next recession they'll go broke again, but what I'm saying is I don't really have a way to estimate when to buy the stock, how quickly it might recover, any of that, using my particular methods, right? So for me, it's just too hard, avoid, not high enough quality history, and so forth. So let's take a look at Nissan as well. I think I'm just going to look at the US ADR. Yeah, this is good enough. So now this is one that's clearly too low quality, because even though you have this brief earnings bump here, it wasn't sustainable. It even fell, I think this is before. So before the pandemic, it even came down. So this was kind of just not real, I would say. And the stock market knew it, because the stock price didn't react to this adjusted earnings bump. So again, you go back in their history, you just pick 2004, which is near the bottom of like a down cycle. And then you go to today and you've lost money for 20 years, basically. So that's not high enough quality cyclical for me. Now, there will probably be a point where this is crazy cheap. Like if you bought it back here, you might have done okay if you held it up through there, right? That's a good CAGR. But it's very dangerous, because if it doesn't recover, then you go bankrupt like the rest of the... And I really just don't think Nissan is the best run auto manufacturer, if I'm just being frank. All right, another one, Ferrari. So with Ferrari, it's sort of similar to the other one. I would say Ferrari right now looks very strong. The stock looks extremely overvalued. But, I mean, I wouldn't tell anybody necessarily to sell it or do whatever, because there's just really not enough information. In theory, rich people can afford Ferraris even in a recession. But I've learned over time that you need to be careful about the assumptions that you make, and without data during a real recession to see what would actually happen. Because there's always going to be some marginal Ferrari buyer out there whose business is going to go bankrupt during recession, who's not going to be out buying new Ferraris. So these markets do still go up and down. I think it looks really expensive right now, just generally speaking. But I want to see what this actually does in a recession and how it comes out of it, like I said earlier. And then I would consider buying it in the future. But right now, this one just go in the not enough data category for me. All right, so now we're going to get into some of the ones that I am tracking. These are the 4 that I decided to track. So Tesla, I have a video out on Tesla. I think that I warned people for a long time. I think I put a video out. Well, I shouldn't say, because I'll probably be wrong on the date. But I warned folks about Tesla a long time ago. And when was it? I think it was early 2021 at some point. But I could be wrong about that. My point is, this was a cyclical business. Everybody said it's secular growth. I think the early one here, I just said it was too expensive. And then later on, I wrote an article. I actually wrote an article, which is the one linked in my spreadsheet, on Seeking Alpha, that came out like right here at this bottom. And I was like, Tesla's a cyclical business. Earnings are going to fall, and the stock price is likely to go lower. Now, immediately after that was published, of course, the stock price jumped like a couple 100% or something ridiculous. Let's look. Yeah, 150. But we're seeing reality sort of creep in. Now, if you look at the earnings, which is what I've been telling everybody, earnings are falling. This is bad. I mean, this is worse than most of the other car companies. So for trading at a 76 PE, and of course analysts did not predict any of this. Earnings were predicted to barely fall or something in 2023 when I wrote that article. But all along, we should have expected that this would be a cyclical business. It's proving to be a cyclical business now with earnings down almost 50% off their highs. So if I use kind of like Ford as an example, which we'll take a look at, I mean, and the fact that this was basically in a bubble, like 85% off its highs is where I would consider buying Tesla. And I'll show you that how far we have to go when I get to my spreadsheet here. So now I also have made a video on Ford. I made this back last fall, I think. And I said, in price-wise, it's a very similar position as Tesla. But historically, Ford has been around a long time. I got a lot of grief because I mentioned the auto bailout when I was talking about Ford, and people pointed out that they didn't take government money, which is true. But the government bailed out the entire industry, basically. And I think if there wasn't government intervention overall, Ford probably would not have made it. I mean, you can look how much money that they were losing. They were losing money before they even went into the recession. So, nevertheless, Ford did recover, but they have a history of 80% drawdowns. I mean, Peter Lynch wrote about 80% drawdowns in the 1990s. So, and that was using data from the 1980s and before. So Ford definitely has a long enough history that you don't want to be buying this unless it's down 80%, basically, for me, for the risk reward to be worth it. So, which I think I can get this on this chart, maybe. Let's see what it was here. I have actually looked, see, it was down 90% during the Great Recession. And then maybe from here, we had this very flashy recovery, which would have been a good time to take profits. And then this one was down about 80%, right? So I'll look at this one again when I get to my spreadsheet, but we can see, I mean, this is a very similar to like the recovery in 2009 and 10, right? Where we get this big spike and then the market just got totally carried away with itself. And it's down about 60%. So we'll look at how much farther it has to go. But I would consider buying Ford 80% off its highs. They have a good history of surviving this type of stuff and eventually coming back. And they have a wide variety of vehicles, so they have flexibility to make adjustments, I think. So the other one is Honda. So this is the US version. I did take a look at the one that's denominated in yen as well on the Japanese exchange because I really kind of like the Japanese manufacturers the best here. And part of the reason is we've had a long period where the yen has been declining, basically, which we've seen with the volatility, kind of some of the changes that's happening. But if the yen just stabilizes or strengthens a little bit, you're going to see stocks like Honda and Toyota, I think, do well. Now, I just bought a Honda Pilot. I read, I'm bringing this up because you might think, oh, well, if the yen's stronger, that's going to make it harder for Toyota and Honda to sell their cars in places like the US because they will cost more money once the currency is adjusted. But the thing is, a lot of Hondas and Toyotas are manufactured in the US or Mexico. So the Honda Pilot that I just bought, other than Tesla, it's the most like US made car, even more than the American manufacturers, because they're made in, I think they're made in Alabama or South Carolina. And when you look at all the parts and everything that go into them as well. So it's a Japanese company, but really they're manufacturing a great, at least on one of their flagship vehicles. You know, I'm not sure about the CRV, it might be in Mexico, but still not so yen sensitive, right? When a lot of the production and everything is being made in the US, right? So for the US market anyway. So that's something to consider. So now, overall, the stock price, if we go back, I kind of picked the low point there. It's not a great return over the long term if you just bought here. But there are flashes where you can make some money, similar to... So there's 150% possibility, which I think is what you're probably aiming for with a stock like this. Now, I will say that their earnings have been much more stable, right? They never lost money, even during the Great Recession. So, while earnings have fluctuated, they haven't been like deeply negative. Also, it's worth noting that their credit rating is like an A minus compared to, well, let's look at some of the others real quick. So, and this can give you an idea of some of the risk, right? Because these are well-known big companies. So, double B minus, right? Barely investment grade for Ford. Stellantis, double B plus. Okay. Who else did we look at? VW, double B plus. GM, triple B. I said double B earlier. I meant triple B on those other ones. Triple B pluses. What else? Nissan. So I'm just trying to give like a context here. There's a real double B plus. Not the greatest credit ratings because the banks know that they're cyclical, right? And that brings in a lot of risk, especially when they carry a lot of debt. But the Japanese companies tend to carry less debt. They tend to have less sort of fluctuation in terms of like their quality. What they haven't had is growth, like a lot of growth, at least with Honda. So it's been choppy and stagnant, but I think if you could get it at a cheap price, even during this little dip here just last year, what do we get up to here? That's a 75% return in a year and a half. So the potential's there, I think, if it's purchased at the right price. And I do think they could get some structural tailwinds. They also, Honda and Toyota didn't gouge people nearly as much during the COVID years. Part of that's because people were buying a lot of trucks, I think. And Honda doesn't really have trucks. That's another not real trucks. They have like a Ridgeline, but it's not like a real truck. That's another thing to consider because I think that as people have less money, trucks are expensive. They take a lot of gas. The traditional truck sales are ridiculously overpriced. Ridiculously overpriced. Over $50,000 for a pickup is ridiculous to me. And not much less 80, 70, 80. And then the expenses of maintaining a pickup truck and driving it and putting gas in it, particularly on the ones that aren't that high quality made anyway, is not a good value proposition for people. Now, when they had stimulus money and the economy had stimulus money and interest rates were quite low, they looked at reasonable. When interest rates are normal and when the economy is going into a down cycle, when people start to do the math, it doesn't look so good. So because Honda has a lot smaller cars, generally speaking, that are higher quality, those are things that people might be willing to pay up for more in the new environment. So that's a potential tailwind, I think, for Honda too. But we do have higher lows on earnings, and we generally have higher highs on earnings. So that's a good trend. But it's not been fantastic growth. We'll put it that way. So we need to buy it low is the point I'm trying to make. Now, finally, Toyota. So I wasn't even tracking Toyota until this week. Toyota has had they had a big decline, cyclical decline during the Great Recession. It took a few years to come out of it, but they did come out of it okay within 5 years. Could have got, we'll call it 150% probably, especially if we went out one more year or a couple more years. So in the general trend, even though it is cyclical, the earnings are deeply cyclical, is up and to the right and pretty steady. Not all that different from Honda, although I will say in recent years, earnings have been much steadier and gradual growth. And this is kind of typical of like Japanese companies. They're usually conservatively run. They aren't doing anything fancy to try to get investors. They're trying to put out quality products, make a profit for everybody, and be financially responsible. They have an A+ credit rating. And they did have a pretty big spike here on this recent bump. You can see they had a kind of a nice earnings surprise. They are, though, having problems with their, their truck engines. I want to call it a Titan, but that is the Nissan one, the Tundra. They're having some problems with some of these Tundra engines, which is not a good look for them, that they're probably going to be replacing, it sounds like. So they've had a little bit of quality control lapse, but I'm pretty sure their reputation will be intact. We can see that the down cycle in earnings is beginning, and the down cycle in the stock price is really falling quickly. This, I think, Toyota looks like it could be the best opportunity out of this bunch. I mean, if you bought during one of these dips and then, held a couple years, that's a 50% return, a 15% CAGR. I think if you can get it down like a 15% CAGR over the medium term for a business that you don't even have to look at night, Toyota's going to work its way through its problems. It's not risky. So if you can get 15% in a business that, even though it's cyclical, even though it's complicated, that's a good bet for me. So if I can get that type of situation, that would be great. I'm not sure what the CAGR was during the Great Recession. If we December to maybe holding up here again, 15. This is 16%. That's buying pretty low on a dip, and then I kind of picked a high, but we can see that those returns are possible, and I don't think they're particularly risky. So also, of all the companies, I've been in the car market for like 3 years looking for a car, and I finally bought one. Of all the auto manufacturers, I think Toyota didn't try to screw over buyers the most. They didn't try to take advantage of people the most. They pretty much had a steady production. The prices were high, but they were always kind of high. And you could pay the same price for a Toyota that you pay for a Ford, and I promise you the Toyota's better. So they offered a much better value and really didn't try to take advantage of customers. And then I also think we can get these Japanese currency tailwinds and stability tailwinds that might not be available some of the other manufacturers in Europe or even some of them in the US. So I like Toyota the best. Let's look at what the prices I'm looking at. So I have Toyota, Honda, Ford, and Tesla here. Tesla, I've talked about. I'm not 100% convinced I would buy it, even if it hit my price, but I would be tempted at $62 a share. That's 68%, about 69% lower than it trades today. Some people may say that's crazy, it'll never happen. Tesla's fallen that far before. So, and that's what it would take to get me in. I'm just saying where I would buy it. Ford, again, this is an 80% drawdown off its peak. Tesla was 85. Ford still has to fall 48% to hit that, and I think it definitely could in a recession. We aren't in a recession yet. We're just starting a cyclical downturn in autos. Now, what could prevent any of these buy prices from hitting are a number of things. The main thing would be if the Fed lowers interest rates, that is enough to spur demand in autos, and people can actually afford to buy some of these cars, especially if the manufacturers meet people halfway and lower these prices a little bit. So that could prevent like a full-on recession price drop like I'm looking at here. But I want to buy these cheap if I can buy them cheap. Honda, about the same as Ford. I want to buy it cheap because I know there's not like super growth, right? It's really buying it cheap, hoping it returns to normal, and trying to get, like, this would produce a 150% return. So if I had to wait 5 years or 6 years for it to recover, I would still be getting a very good return if I buy at a low enough price, right? Toyota looks the most interesting to me right here. I think this is, let me check how far off the high I'm looking. I think it's 50%, but it might be 60. So 55. So this is 55% off the high for Toyota. My buy price, it's 31.87% lower, just under $115 per share. That's when I would step in and buy Toyota. I think that would be as far as cyclical investments go, I mean, Toyota is sleep well at night cyclical investing if you can buy it 55% off its highs. And so that would be just an easy kind of no-brainer buy for me at that price. And it probably has a higher percentage of hitting than these others just because it's a little bit closer. And the momentum right now is pretty rough. I mean, they have gotten absolutely creamed. So 33% in less than 5 months, right? So it lost a third of its value. Now it had a kind of a spiky upturn there. What did it lose back during just a couple of years ago? It bottomed out about 40%. So, but again, the stock price, this earnings, I don't really like to make these bold. I know everybody gets more views for making like bold predictions, but I think the odds of these earnings hitting are like close to zero, right? What do they want? $21, almost $22 a share. If you look in 2022, they were at 15 and they had kind of this swoosh up. And I mean, back to trend for me would be normal. So probably these should be 20% lower as a standard baseline with no recession. That's what I think. Now, I will say with these buy prices, we have had like 20% inflation. So we shouldn't expect them to return down, maybe not all the way down even. Well, this was kind of let's look back here. Where were we at? That's right before the pandemic, right? So let's call it $14 a share pre-pandemic, 20%, more than that is what, another $3 a share, so 17. So, but that's not during a down cycle, right? So a normal earnings is probably $17 a share, we'll say. We had some growth since then too. That was just the inflation I was talking about. So we probably had 7% growth for 5 years. So that's, so 18, $19 a share. That's probably normal, but we're going into a down cycle. So, but that's still below 2021. So I think, yeah, if things go well, they'll probably earn like 18, $19 a share. If things go how they're probably going to go, then I think we're back down to closer to like 16. And then if we have a recession, then we don't know really. Earnings went totally negative back here. They went from really strong to totally negative. So there's definitely economic sensitivity with their business that investors need to be aware of. Now, just because earnings go negative doesn't mean the stock goes bankrupt or whatever. They can come back from that because it's a cyclical business and they're in a good situation. But you just have to realize that these are forecasts by analysts, which I think are just totally worthless at this point. I think they're ridiculous because they're just not paying attention to what's going on. So let's see. I'll review real quick. We're close within 32% of Toyota's buy price, within like 50% of Honda and Ford, and then within about 70% of Tesla's. And you could just mark these down and just sit back and watch, right? And see if they hit. I think there's a good possibility I'm going to be able to get Toyota, which I'm feeling pretty good about. Honda and Ford, that's like probably a 50-50 toss-up. And Tesla, absolutely have no clue. But if something happened and it really got cheap, they do have good product. It's not going to be full self-driving anytime soon, I don't think. So I think a lot of that's just like hype. But they do have good electric cars. I've talked to people that own them. Generally, they like them. And if the prices came down even more, probably more people would buy them. All right, if you found this useful, hit the subscribe button, hit the like button. I usually do individual stock analysis, but I haven't done too many analysis the past couple weeks. So I thought I'd give you like a 10 for 1 here. And let me know if you like this. I might be able to, I have had requests to do these kind of industry things. So let me know in the comments if it's something you want more of. And I can definitely do that. And I'll see everybody later.